Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is president of Financial Resources Group. They're out of Glastonbury, Connecticut. You can find them online as well at www.frplan, F as in Frank, frplan.com. And the phone number, and you're going to want to reach him at 860-657-8380. Let me give you that number again, 860-657-8380. You're going to want to reach him today, tomorrow. Don't let too much time pass. A lot of this is time sensitive. He'll explain why. He's also got an incredible $2,500 in value. It's offered to you complimentary. You got to listen to him, though. Wait till he tells you what it entails, and we'll get into that more into the show. Good morning, Mark. Great to see you this morning.
Hi, Gary. How are you?
Yeah, not too shabby. How about yourself?
Oh, not so bad.
Last week was right after tax day. It was just a few days later. You seemed a little frazzled, maybe a little overwhelmed. Have you calmed down a little bit since then? Or
just a little bit.
Okay.
It takes about 3 weeks to get back to your brain to get back to normal after, I think we're probably going to range close to, I would say probably 250 to 300 tax returns this year. So
my goodness.
And then, with a small staff and me doing too many, I think, but yeah, I'm feeling a little bit more refreshed. That's for sure. I didn't have a chance to get on a plane and book a vacation. There's a lot going on. I have my son's baseball, so I'd much rather see him play baseball than go on vacation.
Of course. You'll go plenty of time for vacation over the summer.
Yeah, I'm only 55. I'll be 55 this year, so I have plenty of other time to go on vacation, so I'm not too worried about it.
Talk about these conversions that you've been doing.
Well, the conversions, Gary, are
do they matter?
They absolutely matter. I mean, you want to do Roth conversion's a hot topic with a lot of advisors, but the most I saw is if you're not willing to go to a 32 tax bracket for most people to get it done in 7-8 years, you're most likely not going to want to do it. I mean, you're losing 32% of your value year one. Over the time of the conversion, then you have to hope that the market goes up and grows. There's products that kind of help offset it. But we've been using tax strategies instead so that you pay very little in taxes on the conversion. And that's something that, I can mock up for anybody. Even as part of that $2,500 deal, we're talking about the full checklist and all the things that we like to cover, Gary. Doing a tax map and doing a tax strategy for somebody on that Roth conversion at no cost or obligation could be potentially very lucrative for them. But,
it's a pretty good teaser there.
We can thread the needle for you and get that Roth conversion done. Most people are going to be able to do $20,000 or $30,000 a year. They're afraid of the IRMA. They're not going to want to do it, and it's going to take them forever to do the conversion. And it isn't going to really matter at that point. It'll have some impact, but the big impact is thinking out of the box, coming up with the right tax strategy, and then helping them do that conversion and pay very little state and federal taxes on that, which we know how to do.
Yeah.
Now, that's not free either. That's something that you're going to have to consider, but we can talk about in detail. There's 30 different strategies, and we're just going to pick the one that fits your situation the best.
Nice. That's a great teaser.
Well, yeah, it's a reality for the people that actually move forward.
Right. Yeah. And there's value to that.
There's real value to that. It's more than you know, because when you get the upside of your Roth, the potential upside of your Roth on the back end and all that tax-free growth, but you get that taxable conversion reduced to very small numbers, then you have even better compounding on the back end when you take the tax bill out. So
today you brought some pretty eye-opening research from a firm called YCharts. It's a data and analytics platform that's really used by financial advisors all across the country. And the report is calling, what's it called? Debunking investing myths. It's all backed by, looks like, decades of market data. So before we get into the specifics here, because I'm looking at it as I'm talking about it, can you just give us maybe a 30,000-foot view of what this research is really all about here?
Yeah, I can. And let me give a plug for YCharts. So for many, many years, we've been working with Morningstar, and I still have a subscription to Morningstar. We use it for building our portfolios and doing deep dive analytics when we're building our models, looking at things like overlap, making sure we don't own too much of the same stock, making sure we're not concentrated in any one sector, making sure that we're truly diversified, looking at all our ratios, our PE, our price to book, your Sortino ratios, all the crazy stuff, all the little things, all the detail that goes into building a model portfolio. So we like YCharts because it is just an easier tool to use. It's newer. It's a little more modern. And again, Morningstar's a great firm, and we still have them. We love them. But YCharts is we decided to start using them about 6 months ago, and we're very happy with them. They were able to blend all our portfolios together, give us some real performance numbers. So we're excited about them. So Good. I was kind of just fooling around on the website, and then I saw this really interesting, myth, debunking investment myths. And I said, oh my God, this would be perfect for the DRC show, because I can't tell you how many times I meet people and they think, well, I'll just put the market's a gambling casino and I'm just going to throw my money in CDs. Or, there's all these different. So I have I think there's at least 10 myths, Gary, that we need to go over to debunk these, because it may not be you. It may be a spouse of yours that you're having a hard time with when it comes to investing. And a lot of times, like a husband will have some accounts, the wife will have some accounts. They both have different risk tolerances. But what we're able to do, Gary, very easily is work with couples to blend together their risk tolerance so that they compromise in the middle and end up putting themselves in portfolios that can potentially grow versus, sitting in a whole bunch of CDs. As I mentioned last time, after taxes, your CDs are paying you less than inflation. So,
all right, so let's start with one that I've heard my whole life. Sell in May and go away. I mean, the idea being that summer's a bad time for the stock market, so you should, cash out and come back in the fall. Mark, is there any truth to this?
There's absolutely no truth to it. In fact, I used to hear this from investment professionals, Gary.
Oh, really?
Yeah. So hopefully if you're an investment professional and you're listening, unless you think you're some kind of super trader and maybe you have a strategy, and I'm sure there's probably somebody with a strategy that does this, that can make it work. It's probably a very small percentage of people. But this is a classic, and the data just doesn't support it, Gary. YCharts looked at an average S&P 500 returns all the way back to 1950. So that's going back how many? 75 years, Gary? 75 years. And here's what they found interesting. May averages a positive return of about 0.46%, so close to 0.5%, June 0.25%, and July 1.13%. So none of these are spectacular, but they are positive, right?
Okay.
And the only truly weak month historically is September at a negative 0.059. Is it worth bailing out of the market because you might lose 0.059%?
No.
I mean, that can happen on a day, right? So anybody who, is getting scared. So if you're going to go away, September might actually be the month you want to worry about,
right?
Not May. But, I don't agree with any of it because you can't time the market. You don't know what's going to happen economically. And again, these are just averages. So I think that's insane.
But someone following that old adage year after year, I mean, what's the actual cost?
Well, the cost is substantial, so that's actually what's the impact. So we like to talk in every meeting, Gary. It's okay. Do I get my power of attorney updated? Okay. Well, if we don't, what's the consequence? Okay, it's going to get jammed up at the bank. It doesn't work with Social Security. You're not going to have access to your money when you need it most. And this is the same thing. We need to create a consequence or for not getting these, for following these bad advice. And the cost is substantial. YCharts ran the numbers. If you stayed fully invested in the S&P 500 from 1950 to mid-2025, you'd earn an average annualized return of about 8.16%. Okay? If you stayed invested. For every year you sold in May and sat in cash to October, so that you sold in May and sat in cash to October waiting for the market, your annualized return dropped to 6.55%. So that doesn't sound like a lot. But compounded over many decades, the difference is enormous. We're talking about potentially hundreds of thousands of dollars on a meaningful portfolio. Now, you're essentially paying a penalty every single year just for following that myth. To me, that makes no sense.
And I imagine you missed some big summer rallies along the way.
Yeah, and I think that, everybody, one of the main things is markets don't respect a calendar. Markets don't follow a calendar. Everyone's like, oh, how did you do from January 1st to December 31st? So, yeah, we want to look at annualized returns. It makes us feel good when we have a great year.
Yeah.
We had a great year last year, legitimately beat the market. This year, we're beating the market. But does that mean I can do that every year? Probably not, right? Let's be honest. I mean, good returns and risk-adjusted returns are wonderful. But can anybody? I don't know anyone who's beat the market for 10 straight years. So,
all right, let me give you a big one here.
Some short-term ones.
This
but
is somebody.
Let me just one other thing. Yeah, so markets don't follow a calendar. So forget about sell in May and go away. Stay invested.
Okay. Here's one that even if you don't follow the trends, everybody knows this. Here, you want to buy the dip and sell the top. And the idea that if you're smart enough, you can time the market and supercharge your returns. But what does the data say about that, Mark?
Well, I'm going to give you, before I even get into the data, in my tax business, all the trading I've seen people do, they must have spent hours of their life in and out of the market, trading, buying, selling, short-term trades on Tesla, buy this news, buy the earnings. And they all end up with pretty much negative balances at the end of the year. Or maybe they'll get lucky and have a big, maybe long-term capital gain. But for the most part, I don't see anyone making money with that strategy. Again, the hedge funds and the people with the big computers doing high-frequency trading and doing quant, the billion-dollar, multi-billion-dollar funds, they're able to do it. But, if you think you can do it individually, good luck. And you're just going to pay a lot of commissions and end up losing a lot of money in the long run. So this is probably, though, the myth that costs investors the most money, obviously. And the sobering statistic from YCharts, again, if you invested $100,000 in the S&P 25 years ago and stayed fully invested, it would have grown to $681,000. So that's $100,000 25 years ago grew to $681,000, doing nothing. Okay? Now, an annualized return of just under 8%. But here's what happens if you miss just the 10 best trading days over 25 years. You're not missing months, just days. You're missing the 10 single best days out of roughly 6,250 days. Wow. Your ending value drops to $303,000. You cut your portfolio nearly in half. So everyone's worried about losing money. What you need to think about is the opportunity cost of trying to time the market.
10 days out of 25 years. That's remarkable.
Yeah, and that's a 50, right, 681 or 303. What number would you rather have?
Well, 681, of course.
Yeah, well, it makes more sense, but it gets worse, Gary. So let's see you miss the best 20 days. Now you're at 176,000. And if you miss the best 40 days, you're at 75. So, is timing the market a good idea or a bad idea?
Yeah, you got to time the market.
Yeah. So you can have 681 doing nothing, timing the market and missing the best 10, 303,000. Timing the market and missing the best 20 days, 176. Or, in the best 20 days.
It sounds
the best 40 days is 75,000. So you actually lose money.
You're losing 25,000.
You're losing to inflation.
Right, because you started at 100. So investors who panic and they sell during this downturn, they're actually doing more damage to themselves, if you think about it.
Yes, they are. And again, having a good advisor, and not the advisor that just says, stay the course, don't open your statements. No, bad. You need somebody who's going to help you keep you in the market. You can buy products that will help you make sure you're comfortable. And those are good long conversations, Gary, getting to know that client well, knowing their risk tolerance. I mentioned many times, bonds are not the answer a lot of times, but having that portfolio that you can just stick with through thick and thin and not worry about panicking or selling. We don't get, I don't know anybody who calls us anymore, at least, with that panic sell.
Yeah.
Very rarely. Because of the way we A, you diversify, B, you have good advice, and C, you debunk these myths.
Here's one that we hear a lot, especially from nervous investors or people who maybe lived through that 2008 crash or the COVID crash. I'll just keep my money in cash until things calm down. Holding cash is safer than investing. Is cash ever the right call?
Yeah, not with inflation, Gary. I've heard this before, too. I have people who have a lot of cash, so they're already very rich. Fairly wealthy. So they're like, I'm just going to sit in cash. I don't need to make any more money. Well, there's not much I can do for that person, right? They're earning a good living, and they just don't like the market, or they hate Trump, whatever. So they're just going to sit in cash. But God bless you. But for the people who really need to grow their money, it's a bad idea. And cash has a role in every portfolio. It's for emergencies, for short-term needs. So having a liquidity plan and an emergency fund and a strategy, absolutely a smart idea. But then again, cash is actually a guaranteed loser against inflation, as I mentioned earlier. And here's the data over the last 30 years, Gary. 30 years of data. So that's a lot of data. The purchase power of a dollar held in cash declined by 56.5%. So 56.7%, excuse me. So that's a pretty big number. Your purchasing power goes down by half, basically more than half. And that means your dollar only buys 44 cents worth of goods compared to what it bought in 1992. So meanwhile, the money market fund, which is about the best you can get with liquid cash, can barely keep pace with inflation. The average over that period is about 2.5 annualized. More recently, we've seen 4.5. But now I'm hearing complaints from clients that banks are paying, 3.5 to 3.75 on their CDs. And inflation is basically right around there after, fees and whatever else. So you're not getting ahead.
Versus actually being invested in the markets, right? Which
Exactly.
you'd rather be doing.
And the contrast is very stark, Gary. The YCharts compared $100,000 invested in 1992 in the S&P, and it grew to $2.84 million through that period. So 92 to that era, that is a very, very, that's been some very robust years in the market, but it grew to 2.84 million, a 10.6 annualized return. So even small cap stocks, I mentioned you need to own a diversified portfolio. Owning small cap stocks, via the Russell 2000 grew to 1.7 million. Now gold, Gary, this is a surprise, reached $980,000, and even long-term bonds hit 559. So there's a lot better options than cash. And meanwhile, the cash in your money market over that period of time only made $228,000. So that's barely more than double your money over 30 years, while the S&P 500 grew nearly 28 times your original investment. So when you hold cash long term, you're not playing it safe. You're actually slowly going broke.
Folks,
so it's slowing a death by 1,000 cuts.
You are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group out of Glastonbury. You can find him online at frplan.com and at 860-657-8380. And I'll give you those points of contact one more time, more towards the end of the show. Mark, one of the most common things people say, and I know that you hear this probably on a daily basis, is stocks are just too risky, right? Especially after like a rough stretch in the market. So how do you respond when people bring that up to you?
Well, there's two types of people we get in these situations. Those who are just scared, those who, we're willing to educate, but those who wish not to be educated. And then the people who are aggressive that say, I'm buying the dip, I'm buying more. But, even buying the dip, if you have that extra cash and you're waiting for that dip, you don't really know what that dip is going to dip or dip more. So that's why we like to just slowly but surely, if you are accumulating assets, dollar cost average, and then you're going to automatically buy the dip, and you'll get the middle somewhere. And over long periods of time, grow a nice bucket of money. But it's totally understandable, especially for someone approaching retirement. They've seen, we've seen people watch their 401k drop 20 or 30% in 2022. But let's reframe what risk actually means, Gary. And, that means stocks that have higher volatility than bonds, they have higher volatility than bonds or cash. But bonds also lost pretty big in 2022. We had all-time highs in stocks, all-time highs in bond valuations, and we had very large rate hikes. And that's something that we planned for. You have to plan for that. You have to be aware. You can't just, growth, and hope that, everything's going to keep going up. So the S&P 500, basically it swings. I mean, so the standard, what they call standard deviations, the fancy term for, risk and volatility, is about 15.7% annually, where long-term treasuries are about 10.7%. So stocks, they can see more volatility in the short run.
But the return on stocks, it's certainly higher over time, right?
It's dramatically higher. And the S&P's delivered, again, 10.6% annualized since 1992. Again, I like to look at longer periods of time than that, but long-term treasuries were 5.3%, cash 2.5%. So yes, you accept more short-term volatility with stocks, but the long-term reward nearly doubles what bonds give you. And there's a great book, by the way, plug for Dr. Jeremy Siegel. I've read called Stocks for the Long Run that proves this over and over again. It's a long read. It's a very thick book, but it is so informative. And I have 2 signed copies from Dr. Siegel. So
nice.
Yeah, it's unbelievable market. His knowledge of the market is beyond anybody I've ever met. and that's why I listen to them on a weekly basis. But the real risk for most investors isn't short-term volatility. It's running out of money in the long run. So if you're not, staying the course and keeping that money invested in good quality companies, and as long as you have good quality companies in your portfolio, and again, those are things we'd be willing to analyze if they're still quality companies. We can, you can make it over the finish line and live comfortably in your retirement.
It sounds like the risk has to be defined by the investor's time horizon, not just their gut reaction to a down market.
Yeah, their time horizon and their tolerance. There's studies that show the older you get, you can actually get more aggressive because you have less time to live now.
Yeah,
and you're not going to be spending as much money. I mean, the real risk to retirees that's not being, I don't think is being told to many, your real risk is in your early years of retirement because that's where you spend the most money, right? You're gonna go on more vacations, more trips, more weddings, and that's your real risk. And especially in your early years of your retirement, if you get a market crash, that can really throw you off kilter. So you need to be more conservative, I think, in your earlier years of retirement than you do need to be when you're 78 years old.
Sure. All right, here's one that's got a lot of people
counterintuitive
that they fall into, especially if they own individual stocks. And it's, this stock has dropped 60%. It has to come back, right? It's just a matter of time. So I'm just gonna hold on. Mark, is this just wishful thinking?
Yeah. It is, Gary. Let me just say at Financial Resources Group, we're building portfolios around evidence-based factors like value, size, profitability, quality, and all rooted in decades of academic research. So we're not guessing, and this is why our investors, our clients, have done well, but also why they don't panic out of the market. And yeah, the fall in stock. This is what I learned this, and when I was young on Wall Street, and the first thing, everybody says, "Oh, the stock just missed their earnings, the stock's dropping," and it's don't catch a falling knife, Gary. That's a very visual thing. Would you want to catch a falling knife? What's going to happen to your hand?
Yeah, of course not.
So don't catch a falling knife, and you don't want to. You always want to wait those out, let the stock bottom, let all the shoes drop, and then if you still think it's a good company or maybe it's a turnaround story, you could step in. But yeah, this is one of the most dangerous myths of all time because it feels logical, and sometimes it's true that a stock does recover. But YCharts showed some sobering real-world examples. AIG, the insurance giant, remember? AIG?
Yeah.
It's still trading 95% below its all-time high. Citigroup, one of the world's largest banks, is 85% below its all-time high. That's been over 15 years since the financial crisis. Walgreens, nearly 88 below its all-time high. And these are not obscure companies. These are household names. So the buy, hold, and pray strategy always doesn't work either. So for those folks that have those old dividend reinvestment programs and you're getting these little dividends and these stocks, but the companies are dogs, it might be time to have us Financial Resources Group review those companies because what they were once great are no longer, and and do something better with your money.
All right, let me see if I'm running out of time. Let's see if I can get one more in here. Let's talk about diversification because people assume that owning more stuff means, you're better protected. Is there any truth to that?
Well, I think there's a twofold answer to that. If you're Warren Buffett and you're or you're some of these other, I say top 1% of all investors, then you can have a concentrated portfolio. But they have teams of analysts. They have people on the boards of the company. They basically they don't just own the companies. They control the votes on the board, so they know what's going on. These are huge companies. I would say most people should just stick around and stay diversified and properly diversified. So what does that mean? It's hard to say, but I would say, but most people would, if you buy, let's say, the 531 holding, what they call sector portfolio delivered. So 531 holdings delivered a 9.45 annualized return since 2021. The maximum drawdown in fancy terms is maximum loss was 19.3%. The more diversified 2935 holding portfolio only annual average 7.3%. So diversification is not going to beat the market, Gary.
Yeah.
But it will keep you invested, and it will keep you from panicking. When some things are up, other things will go down. But the worst max drawdown was a negative 20.62%. So it is interesting. Some of these broad-based index funds had NVIDIA, Microsoft, Apple, Amazon. So if you have concentrated risk at the top, remember I was talking about the Mag 7, how we diversified away from that so that you wouldn't have such big positions there. I mean, NVIDIA hasn't done anything in 6 months. So if you're waiting for NVIDIA to kill it, that may happen again, but the bottom line is, you missed out on the rally, the great rotation. You missed out on that rally where undervalued companies went up. So that's why you have to be diversified. And that's what's giving, at least to date, why we have outperformance in our model portfolio is because we did that diversification in anticipation of these companies becoming overstretched or too big. Or, look, at $4 trillion, you're going to buy a stock at $4 trillion hoping it goes to $5 trillion. I mean, it's huge. So now you have to wait and sit around and see, well, what's the next catalyst going to be?
Yeah, I mean,
let's look at companies that are trading at maybe $5 billion and see what opportunities there are. So I mean, but you have to have a little bit of everything, Gary. That's really what makes it.
Well, it's all counterintuitive because it's really quality over quantity.
Absolutely, and there's only so many good companies out there. Warren Buffett said, buy a company an idiot can run because one day an idiot will run it, and he's right. You
got about a minute left. Did you do your disclaimer? And you want to talk about in 1 minute? Can you talk about your $2,500 value deal that you're offering right now?
Yeah. So obviously, not an offer to buy or sell securities. Past performance not indicative of any future results. Be sure to before making any investment decisions, at least you've heard on this show, it'd be wise to consult a qualified, licensed professional. And then the $2,500 value we're offering, Gary, again, it's worth a lot more.
I know it is.
We're looking at everything. We'll have you in. We want to look at your tax returns. I want to see, especially since we're so close to tax, what if you're overpaying, unnecessary fees, unnecessary taxes, the non-financial stuff, making sure your power of attorney is going to work with your bank.
You take a deep dive.
Insurance.
I know that.
We want to look at your home insurance too because they're cutting corners. So there's a whole bunch of things that we're willing to do for you at no cost or obligation if you mention this show.
Well, let me mention how you can get in touch
not only
and take
that,
advantage
a tax strategy too, a tax strategy that'll help you with your Roth conversion. That is something that I 100% want to do.
Mark, of course, is with Financial Resources Group out of Glastonbury, Connecticut. You can find him online at www.frplan.com. Very easy. And here's the number you should be calling. Call it right now that we're at the end of the show. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Financial Resources Group. Until next weekend, have a good one, everybody. So long.